Hello, everyone. This is Jelena Ogilvie with Principal Wealth Partners, and this is the economic update for May of 2020. To talk about the profound impact that COVID-19 has created, I'd like to first address where we were coming into this year. This graph highlights all of the economic expansion since World War II, the length on the horizontal axis and the cumulative growth on the vertical. The black line indicates the last 11 years, and although it's the longest expansion on record, surpassing the 90s in yellow by almost a year, it's also been the slowest. Less than half of the growth of the largest expansion, which was the 60s, indicated in red. To further put this into perspective, economies evolve through a business cycle. They are referred to as early cycle, which is the recovery phase, mid-cycle, which is the recovery into the expansion phase, late cycle, where the economy begins to contract, into then the recession phase. As you can see from this slide in green, the US, along with most other areas around the world, were in a late cycle in the start of this year. Some indicators of this was a continued slowdown in growth, credit tightening, and earnings coming under pressure. With the onset of COVID-19 and government-ordered shutdowns, the economy accelerated towards China in red and moved towards a recession phase. It's also important to note that the entire world is lumped into this phase of the cycle, which is not common to global historical trends. So are we in a recession? We have all been in quarantine, glued to our TVs, and as a result are hearing this topic daily. What you see here is the history of US GDP going back to 2007, which is the most expansive measure of our economy. Just recently, the first quarter GDP for 2020 came in down 4.8%. The first contraction since 2014 and the worst since 2008, as indicated by the red bars. America is almost certain in a deep recession, yet we can't confirm that until the data comes back months from now. Yes, a recession is scary, and this will be severe in terms of its initial decline. Expectations are that the second quarter will be down much worse than the first quarter. However, although severe, it should be short. Most firms estimate either a lower negative number, if not positive growth, the second half of this year. With social distancing most likely a part of our lives for the foreseeable future, it is unlikely to see a so-called V-shaped recovery, which means that there is a speedy bounce back after a sharp downturn, but rather a U-shaped recovery, starting with slower growth that will accelerate into 2021. The initial phase should have enough pent-up demand driven by a desire to return to life as it was before COVID-19 to grow the economy in a steady fashion. We already see a narrative shift in the media from crisis to recovery mode. In fact, there are some signs of improvement within housing starts and auto sales. The recession of 2020 will likely be characterized by our unprecedented unemployment rate, which quickly went from a 55-year low, which is noted by the gray line on the far right, to more than 30 million initial jobless claims. The unemployment rate is expected to reach 20%, levels not seen since the Great Depression. So why have the equity markets already recovered almost all of their losses despite all of this economic pain? In fact, April was the best monthly return in 30 years. The simple reason is that the economic data is backward-looking and the stock market is forward-looking. This is not the first time that these two don't match up. In fact, it's quite common. Since 1930, the US economy has had negative growth 30 times. In 23 of those, the stock market was up, including both World War I and World War II. The stock market is not always correlated to the economy. This slide shows examples of when the economy was growing and the stock market went down, like in 2002, or when the economy was falling and the stock market rallied, like in 2009. This is another reminder that the stock market in the long term is driven by fundamentals, but in the short term are driven by emotions and expectations. We have seen swift action from both monetary and fiscal policy. The administration enacted 3 pieces of legislation in March, most notably the CARES Act. As you can see, this included stimulus checks for families, unemployment benefits, loans to distressed businesses, forgivable loans to small businesses, aid to state and local government, health-related spending, and other tax breaks. All of this amounted to over $2.2 trillion in spending, which is almost 11% of our economy as we measure it by GDP. Currently, they are negotiating a phase 4 package, which is expected to include funding for healthcare and emergency preparedness measures, assistance for state and local governments, and additional funds for the payroll protection plan. On top of the trillions of dollars in stimulus from the administration, the liquidity provided by the Federal Reserve is also unprecedented. First, they cut federal funds rates by 1.5% to virtually zero and restarted quantitative easing, better known as QE. In the last couple of months, their balance sheet ballooned by about 60% to $6.5 trillion. Monumental as compared to the financial crisis of 2008, where the Fed quadrupled their balance sheet to $4.5 trillion. These purchases are not just U.S. Treasuries, but now include other areas such as non-investment grade corporate bonds. They also expanded a wide range of credit facilities and initiated a new program to provide liquidity to the markets. As alarming as all of these measures have been, it's important to make sure that these emotions don't drive your financial decisions. This is a famous study that shows the return of asset classes over the last 20 years, which includes the stock market in green at 6.1%, a 60% equity, 40% bond portfolio in light blue at 5.6%, a 40% stock and 60% bond allocation in dark blue at 5.4%. Isn't it amazing, with all of this technology we have at our fingertips today, access to information, we still can't get out of our own way. The average investor over the last 20 years is the worst performer of any of these asset classes, averaging a mere 1.9%. In fact, they didn't even keep up with inflation just to the left of that orange at 2.2%. In summary, it is times like this that we must remind ourselves that emotions are not the drivers of our financial plan. Economic data is stale and doesn't always correlate to the returns in our portfolio or our financial picture. As severe as the economy may decline over the coming months, there are several reasons to remain optimistic going forward. These include the monetary and fiscal stimulus, which we discussed, coupled with pent-up demand in an environment where consumers will benefit from lower interest rates and low oil prices. Stay tuned for our upcoming bond update, and any questions, please reach out to any of us at Principal Wealth Partners. We're here for you, and thanks for listening.